Let me tell you about Sarah. She saved up $15,000 over 2 years working overtime shifts and cutting back on expenses. She was proud of that money. Then one evening, her colleague mentioned that the stock market was doing incredibly well. Everyone seemed to be making money. So Sarah, excited and without much research, put all $15,000 into the market on a single day. 3 weeks later, the market dropped 20%. Sarah watched her hard-earned savings shrink to $12,000 almost overnight. She panicked and sold everything, locking in her loss. The worst part? If she had waited just 6 months, the market recovered completely and went even higher. Sarah did not lose money because the market was bad. She lost money because she put everything in at once, at what turned out to be a terrible time, and then let fear take over. But here is the thing. There is a simple approach that many investors use to avoid this exact situation. It is called dollar cost averaging. And today I am going to explain exactly how it works using real numbers that anyone can understand. So what exactly will you learn in this video? First, I will explain what dollar cost averaging actually means in plain English. Then, I will walk you through a complete example with real numbers so you can see this strategy in action. After that, we will look at why this approach can be helpful for certain investors. We will also discuss when dollar cost averaging might not be the best choice. And finally, I will share some practical tips if you are thinking about using this method yourself. Let us start with the basics. What is dollar cost averaging? Dollar cost averaging, or DCA for short, is simply the practice of investing a fixed amount of money at regular intervals, regardless of what the market is doing. Instead of putting a large sum in all at once, you spread your investments over time. Think of it like this. Imagine you want to buy apples at the market, but the price changes every week. One week apples cost $2 each, the next week $3. And the week after that just $1. If you buy $10 worth of apples every week, you will automatically buy more apples when they are cheap and fewer apples when they are expensive. The same logic applies to investing. When prices are low, your fixed investment amount buys more shares or units. When prices are high, you buy fewer. Over time, this tends to average out your purchase price. Hence the name, dollar cost averaging. Now let me show you exactly how this works with real numbers. Let us say you have $1,200 to invest. You could put all $1,200 in at once. This is called lump sum investing. Or you could invest $200 per month for 6 months. That is dollar cost averaging. Let us imagine a hypothetical investment where the unit price changes each month. In month 1, the price is $10 per unit. In month 2, it drops to $8. Month 3, it falls further to $5. Month 4, it recovers to $6. Month 5, it rises to $9. And in month 6, it is back to $10. Now, let us see what happens with each approach. With lump sum investing, you put all $1,200 in during month 1 when the price is $10. You buy 120 units. Fast forward to month 6. The price is still $10. So your investment is worth exactly $1,200. No gain, no loss. But let us look at dollar cost averaging. In month 1, your $200 buys 20 units at $10 each. In month 2, $200 buys 25 units at $8 each. In month 3, $200 buys 40 units at $5 each. In month 4, $200 buys about 33 units at $6 each. In month 5, $200 buys about 22 units at $9 each. And in month 6, $200 buys 20 units at $10 each. Add all those up and you have purchased approximately 160 units with your $1,200. At the final price of $10 per unit. Your investment is now worth $1,600. That is a gain of $400 or about 33%. Compared to breaking even with the lump sum approach. Now here is the key insight. You made more money not because you were smarter or luckier, but because your fixed investment automatically bought more units when prices were lower. You bought 40 units in month 3 compared to only 20 units in month 1 or 6. All for the same $200. So why do some investors prefer dollar cost averaging? First, it removes the need to time the market.